Professor Jagjit Chadha. Professor Chadha is the Director of the National Institute for Economic and Social Research. He used to be a professor here at Cambridge, but now he researches macroeconomic policy and financial markets. He has given advice to the Bank of England and the Treasury, and has also written a book about central banks, which he will discuss today. I will now hand over to Professor Chadha. Thank you so much for coming today. We look forward to hearing from you.
Thank you. Thank you very much. Good to see you all. A very grey Sunday afternoon. I want to particularly thank Nadia and the Marshall Society for asking me along today. Is this the right place for my mark for the camera?
No, it's fine.
To talk mostly about monetary policy, but I particularly want to thank them for organising my talk at exactly the same time as the most important football match of the season. So that's really very helpful. I'm delighted to be here to talk about monetary policy rather than football. Anyway, there we go. And I know a lot of you may or may not be doing economics, but can I just ask who is doing A-level, if that's the right word? Is it still called A-level? Nearly all of you. How many are not? Just a few at the back, a few naughty people at the back. How many doing maths? Okay. Latin? No. Fine. I'm going to start with one observation, and then we'll go on to the economics we want to talk about. People around you may say, study economics, they may say, study medicine. The most important thing for you to study, and in fact later on to do in life, is the thing that enthuses you and interests you and excites you. Now it's really hard at 17 or 18 to work that out. I get that. I was 17 or 18 once myself. But it's important to hone in on something that really does excite you to the extent to which it doesn't feel like work when you're working on it. So you've got to look at the things that interest you, that you want to talk to people about during your leisure time. And that is much closer to the kind of thing you should do as a degree and the kind of thing you should do in your career. If it is something that you really don't like, don't do it. Walk a mile. Do something else. Life is, it may not look like it at 17 or 18, but life is just too short to spend it doing something that doesn't fascinate you. So try to do that in whatever you start to do. Whether that means you come to Cambridge to read economics or something else, it's all fine. You stay on track to do the thing that excites you most. That's the thing you do best. You want to start with that observation. Ignore me if you want, which that's fine. But that's the way I feel about things by my age now. We're going to talk about monetary policy. That's the Bank of England or the Federal Reserve or the ECB cutting or raising their policy rates to affect the level of demand in the economy. There's not a lot of time to go through all of that, but let me say, as I sort of go on, if you've got any questions as I speak, just raise your hand and kick in. Don't feel you have to wait till the end. If you can bear with me for about 40 minutes or so, that's how long it might take me to get through this stuff. I could, in fact, spend 3 hours going through it, or longer, but let me try and get through it in about 40 minutes. And there'll be time for questions at the end. So scribble some questions down as well if you want to ask at the end. But if there's anything that's unclear as I'm speaking, just raise your hand, cough, or even throw a water bottle at me, doesn't it? Just get my attention and say, well, what does that mean? It's fine. Just trying to get you to understand the kind of things that have interested me for over 30 years now. I've been working in this field. And this is the kind of thing that happens sometimes. The screens just go blank. And maybe you might come back and see what happens. Maybe. There we go. Is that back? It's taking its time, thinking about it. Thank you very much. So, as Tony said, I collect some of my thoughts in a book called Money Minders, which came out last year, and I may give a copy away to whoever asks the best question. later on. Classic joke is here, 2 copies to the person who asked the worst question. But anyway, I will give 1 copy to whoever asked the best question later on. And if you like, I'll even sign it. That'll be a start. So let's think about this work. Does anyone follow here anything about the mini budget on September the 23rd, 2022? That's a bit of a sign. Anybody else? There's quite a few of this. That's quite a little bit. Any ideas what it was? It doesn't matter if you get it wrong. You cannot get it as wrong as our Prime Minister and Chancellor got it wrong. Okay? So it doesn't. Whatever you say will be better answer than they gave on that day. That'll be the absolute excellent. Shoot. Sorry?
Yeah.
Yeah, sorry. Yeah.
And find about changing the taxation. The change in taxation system for the top brackets, I think.
Yeah.
And they,
Okay. So we had Chancellor and Prime Minister as, what's your name? Said they reduced. I just couldn't hear what he said. No, I just thought I'd move on. I really couldn't hear because of the acoustics. I could get you all to all sit at the front, but I was told not to say that because people get very worried about that. But as you're saying, just a reduction in taxes. Go on.
an energy cap.
Energy cap. Okay. Anything else? Energy cap and reduction in taxes. So let's think about that. The energy cap is an increase in government expenditure. Energy is more expensive. The government's capping it. The government is spending more money. Unfunded. What? Do you know what that? And it's really all right if you don't understand what that means, because clearly neither did the Chancellor and the Prime Minister. What does unfunded mean? Do you know? Okay, didn't say where they get money. So the government is spending more through capping our energy bills. Gas prices have gone up. Our energy bills, if they are proportional to the increase in gas prices, will also go up. But the government could provide a subsidy, which is the difference between the two, which would then cost it money in terms of expenditure. And if it has tax cuts, there's an idea out there, if you cut taxes, people will work harder, produce more income, so the lower taxes will lead to a higher level of income. Let me say in the short run that's complete rubbish. If you cut taxes in the short run, that doesn't give people a lot of time to reassess their balances and views about life. And what tends to happen in the short run is that government revenues fall. So the idea is, does the tax cut affect the tax base, or does the tax cut simply affect the tax revenue because the rate of tax you're applying to the base has fallen? Now, in the long run, there could be an impact on the base. As those incentives kick in, firms invest more, or people decide to do different types of work, but it doesn't happen very quickly, if at all. So the two measures we had were all about increasing expenditure and reducing revenues, which increases the deficit. If it increases the deficit, the extent to which you think about this in first principles, if you're spending more as a government, you're taking in taxes, you increase the deficit, you've injected something called demand into the economy. Does everyone get that thinking? You've injected demand into an economy that has deficient demand. That's a good thing. If you're in a deep recession with high levels of unemployment, with people not spending money, the government says to itself, in those circumstances, I would inject a bit of demand into the economy so that I get back to something called full employment. That might be a good thing. In fact, those ideas were very much espoused in this very faculty, predominantly by Maynard Keynes, but a number of people around it in the 1930s. Very deficient demand you want to offset. But equally, you may not want to do that if the economy is inflationary. If there's a boom, if demand is greater than supply, it may not be a good idea to inject more demand into the economy. Do we sense the intuition of that, at least, if nothing else? Demand is already racing ahead of supply. Now, why was that last year? There were supply shortages, supply chain problems, about which you've already heard about somewhat this morning. People hadn't fully gone back to work. Indeed, there's a participation problem that remains. Large numbers of people at either end of, this is going to keep happening, but British economy, really. It's a very good parable. At either end of the age spectrum, haven't gone back to work in the way we would have anticipated. So that lack of supply has generated a situation where demand was in excess of supply, inflation was rising. Inflation was also rising because energy and food prices had gone up, which also further restricted supply. There's also another big impact that's affected supply for nearly 7 years now, on the UK economy in particular. Would anyone like to hazard a guess as to what that has been, that effect for the last 6.5 years? And it doesn't matter if you get it wrong. Our political readers were getting it wrong for a long time. At the back, halfway up, with the, that's you, with the blue. Hasn't shrunk. The economy is higher in terms of GDP output, but it's not that much higher. GDP per head has gone down. But I appreciate the point. But the question was why? Somebody else here? Second word, with the B and the X in it, that no one wants to talk about, is exactly the reason. Brexit. It's contracted the supply side of our economy in a quite profound way, through trade, migration, investment, capital, but I leave you to draw your own conclusions on that in time. But the fundamental point is, in the second half of last year, on September the 23rd, in an economy that was inflationary because demand was ahead of supply, supply was constrained, demand had been bolstered by very low interest rates, the government decided to think about injecting another 2 to 3% of GDP into the economy in a mini budget that wasn't assessed by independent economic institutions, the Office of Budget Responsibility, the APC of the Bank of England didn't have a look at it in advance, and the Treasury had been decapitated. 2 people at the top of the Treasury had been sacked over the summer and were therefore telling everyone that this government wasn't going to listen to economic orthodoxy. What was the impact? This is a plot of long-term interest rates in the UK. Just going to... Sorry, just... There we go. This is a plot of long-term interest rates in the UK. On the x-axis is as the year progresses from January onwards. On the right-hand axis, on the y-axis, is just the long-term interest rate. So if the government is borrowing from international financial markets a certain amount of money over a 10-year period, it's telling you what rate of interest the financial markets want in order to lend UK PLC money. Is that clear? Now, we think about these things as 10 or 12 or 15 years, because there's always a lag between the government getting revenues and the government spending money. So it always has to borrow money. But particularly if the government is investing in the longer run, building hospitals or roads, it has to also borrow over the longer run. So the financial markets are saying, well, if we're going to lend to the UK PLC, what are the alternatives? In which other countries could I lend for 10 years? In what other projects could I lend for 10 years? So this is generally a view about how safe it is, or risky it is, to lend to UK PLC. It's very much determined by a lot of things, as well as the bank rates of the Monetary Policy Committee, but the expectations of that bank rate over a 2-year period. And what you can see is at the beginning of the year, the expectations over 10 years, the average interest rate would be about 1.5%. So that's what that long-term interest rate is telling you. Now, over the first half of the year, bank rate, that's the very short-term overnight interest rate that the Monetary Policy Committee said, was gradually going up. In fact, in 10 steps, from December 2021 through to just the week before last, bank rate has gone up from 0.1% to, does anybody know what number it's gone up to the week before last? 4%. Very, very good. So a lot of people are saying that's a huge, huge increase in interest rates. Clearly, if we've gone from 0.1 to 4% for very short-term interest rates, over the long term, people are taking the view that it's going to stay at a higher level for longer. So over the course of last year, we saw interest rates rising. This was a global phenomenon. Interest rates rising is not necessarily a bad thing. Interest rates have been very low for a generation, most of your lifetime, in fact. Since after the financial crisis, around 2009, interest rates hit near zero in the very short term, which means in the long term, interest rates were 1% or so, which is historically astoundingly low and problematic. And at some level, not providing us an incentive to invest in the most productive firms. Because any old firm could pay back debt at 1%, but if interest rates were 4 or 5%, only the more productive firms can. So you might end up in a world in which you're stagnating because interest rates are too low. But that's outside the context of this talk. What I want to point to is that the mismanagement of that mini budget, can you see that nearly vertical line in the middle of September? Shot up bond rates from around 3% to 4.5% or more in a day or two. It's a huge collapse in bond prices and an increase in interest rates. In order to lend the British government money in a day or two, the interest rate for 10 years went up from something like 3% to 4.5%. And that's because people took the... I'll just finish the sentence and I'll come to you. People took the view that if this government was going to stay in place and continue with these policies, and there was a statement on the Friday, the mini-budget, and another statement on the Sunday, on the 25th, by the Chancellor saying, and there's more to come, that this was going to be a government that was going to continue to inject ever higher levels of demand into the economy, which the Monetary Policy Committee of the Bank of England could only deal with by raising interest rates to a much higher level than they otherwise would have done, which then led to the longer-term interest rates climbing very quickly. A view about future policy by politicians led to a collapse in bond prices and an increase in interest rates. Very, very quickly. Please, sorry, I just wanted to finish the sentence before coming to you. Yeah.
Could you please clarify what PLC is, please?
That's a public limited company.
Oh, okay. Thank you.
So when we sometimes talk about the UK, it's about UK PLCs, it's about the whole country. But PLCs are private companies that might be lending as well. So there's a corporate bond market. If I'm a large private company, let's suppose Sainsbury's or Tesco, I may want to borrow money from financial markets in order to build a new supermarket, and I'm borrowing at a certain interest rate, and that tends to be above the interest rate that the government borrows at, because the government is thought to be less risky. It can always have tax revenues. Is that okay?
Thank you.
And what you can also see are the prices of equities traded every day. So every firm that's a public limited company would have the price of its equities going up or down as a function of its likely profitability and its likely risk. So a more profitable firm would tend to see its equity prices rise, but a riskier firm would tend to see its prices fall. And in fact, on that day, keep you busy today, I know, I'm so sorry. In fact, on that day, on the 23rd, not only did bond prices fall, sterling, that's our exchange rate, fell very rapidly against the dollar, and equity prices fell. That's the underlying price of firms. So it was certainly thought to be a shock to UK PLC's risk. So when I talk about UK PLC, I mean the country rather than private limited. Thank you very much. Sorry about that. I'm always causing trouble. This is a character trait. Okay. So where are we now? I'll come to the end, right at the end, about how you deal with things like mini-budgets and prime ministers like Liz Truss and chancellors like Kwasi Kwarteng. They certainly have given me an opportunity to write papers. I thank them for that, if nothing else. Now, where are we? As we can see, this is the National Institute, of which I'm the director, provides modelling and advice to not only Treasury, Bank of England, OBR, but many central banks and other organisations, the IMF, OECD around the world, we've been going since 1938, set up by Keynes himself on the 7th director of the Institute, and this is one of our quarterly analyses that we published on Tuesday. I think we were in front of the press. And what you have there is a British economy that is, if not in recession, growing very slowly. The thick black line is telling you recent year-on-year GDP growth, and as we move ahead with the probability density function, that's the probabilities there. Each band there represents 10%, so the whole of those fan chart, the whole of that fan chart represents 80% probability of where GDP will be. The thing to note here is that the long-run GDP growth in the British economy is around 2 to 2.5%. Over this forecast horizon, which takes us through to about 2027, we're not probably getting anywhere near 2.5% with anything other than a 30 to 40% probability, about 30% probability of reaching the historical long-run trend. So the UK is in a depressed economic state. This is GDP, not GDP per head. So it's just telling you the flow of goods and services produced every year and its increase over time is going to be almost barely perceptible over the medium term. There's no great growth going on. And growth of production of goods and services things that provides income. And that means that for many people, their incomes will not be increasing very much. And if you add to that a worsening distribution of income, you might have a world in which many will see their standards of living fall while others are increasing, which might be on average a small increase in growth, but nothing perceptible for large numbers of people. The good news is, for you in the room, is that for those of you going to university, you're more likely to be in that top group of people whose income are growing. But the equitable question, the moral question, is whether that's the kind of society we want. I'm not going to go into that just now, but these are open questions that we're trying to consider, many of which have been exposed by our experiences over COVID over the last 3 or so years. And we realise we have to rely on people to get by in a way that maybe we've forgotten, and certainly people of my generation have forgotten. It's interesting to see our view on collectivist views. So there's an economy that is not doing particularly well. At the same time, we've had this, what's everyone calling cost of living crisis, where inflation has gone up to a level not seen for 30 years or more, double-digit inflation. If inflation stayed at 10%, the value of money would halve approximately every 7 years. So far away from price stability. And why do we think price stability is a good idea? I think when we're planning, it's good to have an idea of what prices will be in the future. Whether you're a firm or a household, you're less likely to make mistakes in terms of having the wrong level of nominal income. Leads to, if we have higher levels of inflation, leads to price distortions. It's hard to tell which things are in high supply, which things are in short supply. Everything is going up together. We can't necessarily expect the price mechanism to provide clear signals to us all as to what to do. And the extent to which those distortions occur mean that large numbers of individuals may find that they've made the wrong decisions because the price mechanism is not providing the signals we want it to. And we think all of that is costly. Much easier to have stable levels of inflation, around 2%, but it's much easier to tell whether a particular good or not is in high or short supply, and whether we ought to be providing resources to it, or indeed whether our real wages are rising or falling, and which sectors we should work in. So we want inflation to come back to 2%. By and large, the increase in inflation that we've seen has been very much the result of an increase in energy prices. Food and energy prices firstly started to go up because there were supply chain problems at the end of the COVID period, towards the end of 2021, but then that was exacerbated by the Russian invasion of Ukraine. It not only jacked up energy prices and gas prices, but also food prices, as we discovered that Ukraine was providing a large amount of exports of grain to the rest of the world. When I say discovered, I mean globally, in the sense it's something that we hadn't realised was going on. Inflation rose rapidly to 12%, and at least approximately, that increase in inflation is the cause of that increase in interest rates that we've just been talking about, to try and bring inflation down. And inflation is brought down by an increase in interest rates through a number of mechanisms. Higher interest rates provide an incentive to delay consumption, that is, to save. Higher interest rates might encourage firms to wait to invest because they need a higher return than they would have under low interest rates. Higher interest rates will tend to put sterling up, which is our exchange rate. Oil, energy, food, stuff's all priced in dollars. So if sterling goes up against the dollar, that helps keep inflation down. If sterling falls against the dollar, we saw in September, it provides another jolt to inflation. Higher interest rates are used to price mortgages that people are using to buy houses with. If those interest rates go up, it's going to make those mortgages more expensive and take more money out of people's household income. That will reduce overall demand. It also may affect financial wealth, either in housing or in equities or other forms of wealth. So if higher interest rates drives down financial wealth, that might also reduce consumption. What we tend to think is that consumption is proportional to people's permanent income or their wealth. So there are a large number of avenues by which interest rates might be impacting on demand. And that's what we're seeing with interest rates having gone up from 10 basis points to 4%. Is everything okay there? Can I help? Everything all right? What we can see is that it's not anticipated that inflation will come back to something consistent with price stability for at least another 2 or 3 years. 2025, 2026. Now, the normal horizon of monetary policy is around 18 months to 2 years. And the question being asked is, why is it taking so long for inflation to come back? Well, there are a number of reasons. It's coming down from a very high level. It's going to take time. But there is a number of decisions the monetary policymakers could make right now that could bring inflation down much more quickly. If they raise interest rates to an even higher level, that would amplify the effects I've just been talking about, as well as supporting sterling, and that would lead to inflation falling more quickly. But, we're a highly indebted economy. Household debt is about the same size as output. Public debt is about the same size as output. We might be an economy that's very sensitive to increases in interest rates and large increases in interest rates and a change in regime. For 12 years, interest rates have been near zero. Moving to interest rates of 4 or 5% is a different regime, a different system. It's entirely possible that the economy could respond in a very elastic or sensitive manner to those increases in interest rates. So it might get inflation down, but at the same time, if it were to bear down too strongly on output or activity, it might lead to a deeper and longer recession than we might think, jargon coming up, is socially optimal. I'll leave you to understand, think about what I mean by socially optimal. I'm not sure, ask me. But you might take the view that let's do it more gradually, let's not have large levels of unemployment and a long recession, because we think that's more damaging, as people may be thrown out of work, that might leave some, another word coming up, scarring in the labour market. People who lose their jobs don't go back into the labour market or have skills that depreciate, that ultimately affects the supply side and productivity of the economy. I said right at the beginning, the supply side of the UK economy is already fragile and problematic, and you might not want to inject more problems in it by being too aggressive against the inflation. So the idea is you might want to use the reputation that you've got with the Bank of England and the Monetary Policy Committee. Does anybody know when the Monetary Policy Committee was set up? Has anybody heard of the Monetary Policy Committee? Has anybody heard of the Bank of England? Good. The Monetary Policy Committee, anybody know when it was set up? Brilliant. Do you know the date? That's right. May the 6th. The story for another day, but I was in the bank all day, so it was all something ingrained in me. But I might come to that. Exactly right. 25 years, last May. And the average inflation rate over that period is measured by the CPI, Consumer Price Index, was 2%. So, as it often is in these things, as soon as you celebrate the achievement of an objective, it falls to pieces. So suddenly you have a very large shock where inflation went up. But the question is, maybe you can use the fact that you've had this long history of having hit your target to allow you to smooth the response to a shock, so you don't have to bring about a prolonged or deep recession because you think ultimately that's damaging to the economy. If you didn't have the credibility or reputation, you might have had to raise interest rates by even more in order to bring inflation down. So it's a question to discuss. Is it better to bring down inflation quickly and take the risk of a longer recession? Or is it better to take the gamble that your credibility will ultimately bring inflation down and you can move more slowly and have less employment, less unemployment? Your view on that might boil down to something you might hear in the press talked about as a distinction between monetary policymakers as to whether they're hawks or doves. Have you heard that distinction? A hawk is, I won't do it with a hawk, that'll just be embarrassing all round, but a hawk is someone who wants to bear down inflation all the time, do whatever they can by raising interest rates. A dove is someone who's potentially more concerned about unemployment and output and wants to do it more gradually. In fact, the governor of Bank of England 2 governors ago formed the same distinction, but he used slightly fruitier language. He talked about inflation nutters, people who always want to bring inflation down, and employment nutters, people who always worry about unemployment. I quite like the nutter approach, but it gets lost in translations. Let's move on. All right. I've already talked for quite some time and just gone through. So what I'm going to do is a lot of these ideas about what central banks have learned about short-run demand management and monetary policy objective, I think I've already talked through in my opening remarks, so I'm not going to repeat myself here. What I'm going to do is just reasonably quickly, but if it's too quick, do stop me, just go through some observations on the economy that help guide the monetary policy maker. So first is that this is a paper published recently looking at output per head over the very long run, and in 2020, you can see that in the very long run, we're getting better off. Those of you who were around in 1700, maybe a few of you were considerably poorer on average than the people we have today. So we need to bear in mind, as an economy, through the process of economic growth, fortunately, the average person is getting better off. But around that, we can see both sections. And the grey lines there are recessions, periods in which the economy is growing slower than trend, or where output growth has gone negative. Either of those things. So you can see frequently these recessions are coming along. They're coming along less frequently over time. And one of the reasons they're coming across less frequency over time is the use of demand management. Fiscal and monetary policy seemingly seems to be helping us avoid as many recessions as we had in the pre-industrial age. There are other factors at work here. We're a less agricultural economy. There are a large number of goods and services that are producing that provides a variety, which means that a shock to one sector doesn't translate to all the others in the same way. There's a lot of other things going on. But one of the reasons is that we think that we're running a science of monetary policy better than we did a couple of hundred years. And that's a good thing, because on the margin, recessions affect poorer households more than they do better off households. So it's also good for income or wealth inequalities. But monetary policy is not concerned about the long run, as I've said. It's all about helping to control short-term fluctuations so they're not excessive and or they don't spill over into the long-run growth consequences of the economy. And so, what monetary policy is about is moving bank rate up or down to affect the economy in the way I said some moments ago, affecting demand, and lead to a stable level of inflation. And just showing over the same period, bank rate in the solid line is the Bank of England's policy rate, and underneath that, the dotted line, are the inflation rates. And in the period from around 1700 to around 1914, the average inflation rate was 0. Quite volatile, but there was no drift in the price level over that period. In the 20th century, we had 3 bouts of inflation, 2 of which associated with wars, World War I and World War II, and 1 associated with a sequence of oil and price shocks in the 1970s and 80s. We went through a period in the 80s and 90s of bringing that inflation down to something associated with price stability, and at the same time building institutions around that. Central bank independence, treasury scrutiny of expenditure plans, ultimately in 2010 with the establishment of the Office of Budget Responsibility, and more openness and transparency about both monetary and fiscal policy, so that agents, whether they're in financial markets or individuals or households or firms, just had a better idea of where policy was going. The unusual period, right at the end, you look at that, that's the only extended period we can see where bank rate was below the inflation rate. That's the period in which real interest rates were negative. And that's all following the financial crisis. Huge shock to the global economy, particularly in the UK, as an economy that was so concentrated on financial services. We also suffered a much larger shock than many other countries. But as a consequence, as we were working our way out of that, and to some extent some would argue we still are the start of that shock, short-term real interest rates have been negative. So one crumb of comfort I would take from the increase in interest rates that we've had in the last year is that at the end of this process, when indeed in 2 or 3 years' time inflation comes back to 2%, and bank rate is at 3 or 4%, we'll go back to the more normal world of positive real interest rates rather than negative real interest rates. And positive real interest rates, as I said earlier on, provide an incentive to save and an incentive to allocate capital to the most efficient firms, which we think is good for economic growth. Now, some would argue that and I think I've already alluded to this, there's a short-term trade-off between inflation and unemployment. So when we try and get inflation down, we might have a period of higher unemployment, and lower unemployment might tend to put inflation pressure up. And the idea here is that simply, as discovered by Bill Phillips, by looking at UK data over the 19th and 20th century, that there was indeed a negative relationship between the two. And many would still argue there's a short-term negative relationship between the two, and that's how monetary policy operates. This action on demand to reduce it to bring inflation down, and one manifestation of demand is the level of unemployment. It's worth remembering the relationship between unemployment and inflation was the one originally suggested by Phillips, but in the end we think of it as something affecting demand. And later on, as monetary thought developed, people said, well, we care about inflation, we also care about output. And let's suppose this target that we have for inflation output represents a bliss point, something that we'll be very happy about. If we get output to grow in line with trend output, and inflation is consistent with inflation stability, call it 2%. So the y-axis there represents 2%. If output growth is also 2%, that represents 2%. And it's quite intuitive to understand that if I've got 2 objectives, inflation and output, if I'm going to get 2 objectives to where I want them to be, I'm going to need 2 instruments. So I'm going to need something that affects inflation separately from something that affects output. If my instrument affects output and inflation jointly, I can't hit both those objectives. So there was a long period of people thinking, what can I use to affect inflation, and what can I use to affect output? And it doesn't take a lot to realise that I kind of ended up with the view that maybe monetary policy can affect inflation, bring it to the place we want it to, and maybe fiscal policy, by using deficits or surpluses, might be able to affect output. And this was the way that people started thinking about things in the post-war period, potentially using fiscal policy to drive output to where you wanted to, and inflation was going to be set by the use of interest rates. Now, the problem with the bliss point idea is that the economy might be constrained. So again, if you study economics, you'll come across the idea of not an unconstrained optimum, but a constrained optimization problem. And so this black line that's sloping down to the left and right might represent the underlying structure of the economy. That Phillips curve that I put up some moments ago tells you that you have to be on that line somewhere. If I want to have a particular level of inflation output, it's going to lie on that line and nowhere else. If I have structural reform in the economy, that line might move up or down. But at any given moment, it's somewhere on that trade-off I have to pick. So in that world, the best I can do is not the bliss point, but the pi star and u star. That will be the best I can do. It's worth bearing that in mind. That's the so-called second best that's available to us. But even though we might want a lower level of employment or a lower level of inflation, our economy any given moment may not be able to achieve that, and we might have to settle for something else. That's another problem. And this is germane, I think, to the problem that we're currently facing. What if the use of my instrument itself has some uncertainty attached to it? There's a world in which, when I drive my car, I know that it will take me exactly 15 minutes to get to where I want to go. On the other hand, when I drive my car, let's suppose I'm a bad driver, which I may well be, I may well affect other road users. And as a result, they will interact in a way that I can't predict. And it might take me longer to get where I want to go to, or shorter time to get where I want to go to. So my actual driving of the car is changing the system dynamics and leading to some uncertainty in the response. So I have another trade-off I might want to face as well. And if I don't like uncertainty, I might want to respond against that. And a good example here would be, well, let's suppose I have inflation at A, which is far below target. And I want to get it up to C, which is where my target is. Now, if I want to get inflation up from A to C, I'm going to want to reduce interest rates to increase the level of demand, which will lead to a higher level of inflation. But if I'm not sure that lower interest rates will lead to higher inflation, indeed, the lower interest rates have an uncertain impact on the economy, I might be increasing the inflation variance. And therefore, by reducing interest rates, if I'm increasing inflation variance, that becomes another part of the trade-off, I may prefer B to C. I may prefer to undershoot inflation rather than take a risk with even more inflation uncertainty and go all the way to C. B would be preferable. It's another example of a constrained optimization, because I'm not sure that my instrument works in the way that I want it to. And in this world, I'm doing less than I would want to do. And this is analogous, potentially, to the problem that we currently have. I might want to just flip that around. Imagine A is above the dotted line. I might want to increase interest rates by a lot to bring inflation down. But because I'm uncertain how this economy will respond, we've had Brexit, we've had COVID, we've had a large increase in energy prices, we've got an economy with a large amount of debt in it, we have economic structures that are fragile. So I don't know exactly how inflation will respond from a large increase in interest rates. I may well want to overshoot for a while because I don't want to deal with the uncertainty that I will be injecting into the economy by moving all the way up to the level that would definitely bring inflation back down to target. So I'm gradual. So, even if I've defined my targets and I know my instruments, I'm facing a number of constraints. The constraints by the structure of the economy, and the constraints of my own knowledge about the economy, and the constraints offered by my uncertainty as the impact on the economy. This is the problems that we face. And I'm going to not talk about these because I'm going to just run out of time. think. So how do we deal with these problems? Well, in order to be robust against large numbers of shocks and the kinds of uncertainties that I've been talking about, we do need to build a social consensus for what our targets are. So if it's price stability, we kind of want people to understand why we're shooting for inflation around 2%, why that's the best thing to do. And if you can convince them that's the best thing to do, it's much easier to hit that target because people will incorporate that target in their own planning. Much easier if everyone else is trying to do the same thing as you, rather than you rubbing against people the wrong way and trying to get to somewhere they don't understand. And that's what we mean by social consensus. Equally, we have a social consensus for low and stable levels of unemployment. Nobody thinks employment of 12% makes a lot of sense. Nobody thinks unemployment of 1% makes a lot of sense, because that would be over-employment. At any one moment, a fraction of people are looking for a job. So as a result of that, we tend to think unemployment of somewhere between 3 and 5% makes sense. If we have a consensus, the politicians can set a target for the experts to pursue. Politicians can say, look, we think society wants 2%. We're happy for you to hit that 2% target using the instruments that you've got. And a similar idea could be used for fiscal policy as well. And to an extent, the Office of Budget Responsibility is doing that. It's asking the question of government policy whether it will hit a given target for debt to GDP over a certain amount of time. But that analysis is carried out by experts, and certainly in the area of monetary policy, the decisions are carried out by experts, because it's felt that they're sufficiently able to make decisions without having further trade-offs that they have to worry from. Would it be hard for a politician to raise interest rates the month before an election? Possibly. If we think they won't raise interest rates before an election, we might crank up our inflation expectations as a result. If we crank up our inflation expectations, it becomes more sticky and stubborn in the system and harder to get down. That means in the end, interest rates have to rise higher than they otherwise have to do so. On the other hand, it's quite easy for a central banker to do that because they're not trying to get elected the next day. So this disconnect between other sets of trade-offs are very important. We face these trade-offs anyway, but when you add more objectives, you end up with more trade-offs. It's important that we try and avoid it. So what happened on that day when the Bank of England became independent? Remember, I started by, why are you coming now this time? Yes, now I'll go
Sorry.
That's all right, don't be silly.
It was a question about inflation variance, and I just wanted to clarify what that meant, because from what I understood, is that basically like the uncertainty of how inflation changes? Or
Yeah, it's not only aggregate inflation, but aggregate inflation is made up of many thousands of individual price series. So all of those price series may be more likely to change. Some of the changes we've seen in the last year have been enormous. Some price relatives have gone up by a couple of 100% in some cases. So it just leads to this kind of overall set of information that's much harder to understand when you've got large numbers of price changes changing a lot than if you've got a relatively small number of price changes changing not a lot. So the processing of the information becomes very difficult when inflation grows. Does that answer your question?
is it just like the difficulty in seeing? Oh wait, no. Could you please explain it again when like?
No. So I want you to imagine that inflation is at 2% and all prices go up by 2% all the time. So in that world, it's very easy to see if one particular good is going up by a little bit more, by 2 or 3%, it's going to stand out. Now imagine there's a 10% inflation and some items have gone up by 200% and some items have gone up by a lot less, and they're changing more frequently as a result. You can't wait under those circumstances to reprice. As a result, it gets very hard to understand what's happening to all prices in that world. And if you don't understand what's happening to all prices, you may well find at the end of the month you haven't got enough money in your bank account. Or a firm may misprice its goods. Imagine you're a chief executive officer of a huge company in a few years' time, and you're pricing a contract about how much you supply goods and services for. But 3 months down the line, all those prices have shifted because we've lost price stability. You might end up losing a lot of money from that contract because you've got your prices wrong or your wages wrong. In a world of price stability, that kind of problem is much less likely to happen. Does that help?
That's a lot clearer. Thank you.
So, we started with the long-term interest rate. Just before, I think on the Thursday or Friday, the Monday was a bank holiday, long-term interest rates in the UK at around 10 years were 7.8%. The announcement alone of central bank independence on the 6th of May, which was the next trading day, led to a fall in long-term interest rates of around 0.5%, and that persisted. That paid itself off many, many times, because over those intervening 25 years, there was so much debt issued at lower interest rates than it would otherwise have been. There's a tremendous saving to the UK state as a result of that. And that's a world where we went from the central bank not being independent to the central bank being independent. And the concern on September the 23rd, with that large increase in rates, which was the opposite direction to this, was that we might have reversed all of that because we were seeking to undermine the independence of independent economic institutions in the country. Just a demonstration of the benefit, potentially, of central bank independence. Just capturing here inflation output performance in the post-war period. Suffice to say that we've got a much more variable output in inflation performance, perhaps following on from the question a minute ago, in the 50s, 60s, 70s and 80s. There's this exceptional period, which I call the long expansion from 93 to 2007, when inflation was low and output was growing around trend, very tight distribution of outcomes. And in the period up to at least COVID, even though inflation continued to be stable, we had, both from the financial crisis and COVID, large falls in output. So you can see estimates to the left-hand side in terms of output there as well. But it does look like the regimes that we've had suggestive of the important influence of independent economic institutions that have helped lead to more stable macroeconomic outcomes. I've talked about bank rate forecasts and tightening, so I don't need to go over this again. Perhaps I should have put this slide up a little bit earlier. The control technologies that we're working with have to deal with uncertainties of very many types. What I haven't talked about today is the extent to which that might require some game playing and manipulation of expectations. But all of the expertise that the bank, Treasury, OBR, IMF, OECD, National Institute of Economic Treasury Research published, is all about trying to demonstrate appropriate scrutiny and transparency of decisions that will mean that when you're forming your expectations about the future, you will take an appropriately rational view about where economic magnitudes will go, and you will plan in a manner that's consistent. In the end, all we want to do is guarantee the public good of sound money so that we can plan in a sensible way over the future. I hope that over the years you will think about these things as well, and in the end perhaps come to better solutions. It's almost impossible to go through all the things I might in one short lecture, but I hope I've given a flavour of the kind of things that we think about in universities, as academics, as policy advisors, and people sitting around the world worrying about how to deal with an incipient inflation, sequence of shocks that we've had, to try and bring about policy that minimises the distortions in lives being lived by people around the world. Thank you very much.